Please welcome our renowned keynote speaker, Dr. Lawrence Yoon, who will present economics and the real estate market. Thank you, Dr. Yoon.
Thank you, Rick, for the introduction. I believe this is my third visit to this economic summit. I try to come every other year, trying to work out the schedule. I am very happy. This time around, I was able to bring my wife, who is visiting for the first time the Gulf Coast of Florida. She's been to the Miami side, been Orlando. So after this event, we're going to take a few days off over in, well, I'm not going to mention where's, because and I also want to thank President Rick Beransky for inviting me to this great board of realtors. The market condition, because you are certainly interested in what you can anticipate in your business, whether or not if you are a broker to expand or you should be cautious. The earlier speaker mentioned maybe on commercial building acquisition, you may want to pause because we are running into an internet age. But I can also say for commercial real estate members that because of the underproduction in the commercial real estate, there's really no oversupply, and that's a fortunate thing. So even as some companies trying to scale back on some of their actual brick and mortar spacing, that with the continuing expansion and economic growth, there will always be some demand. But fortunately, there's no oversupply. So let's go over to see what you can anticipate about the market condition. And let me first start off with the big issue that we had focused latter part of last year, tax reform. When the tax reform was first being discussed, there was a sizable number of Americans who say, go for it. This is what we need to upstart the economy, get it moving again at a faster pace, or you can use the word, make America great again. So people are saying, let's get the tax reform going. Other Americans were concerned that this could be a giveaway to the rich, and it could exacerbate some of the inequalities. How did the NAR view it? First, we are a real estate organization looking strictly from real estate angle. And when it was beginning to be discussed, we were concerned because they said, let's take away the mortgage interest deduction. Let's take away the property tax deduction. Why? By removing the deduction, one can lower the tax rate, and lowering the tax rate will incentivize people to work more. So that was being all discussed. But we said, wait a minute. The tax preference for real estate has been in place for 100 years. And to switch radically, taking away deduction could be very disruptive. So we began talking about how the Americans have built wealth through real estate. We need to provide access to it. So the end of the day part, if we can see the slide, is that mortgage interest deduction became law with $750,000 in deduction, rather than zero or say $500,000, which was what was passed in one of the chamber in Congress. The property tax deduction, or something called SALT, state and local income tax, was to be zero, but it was settled at $10,000 when the bill was passed. Capital gains exemption. When you buy stocks and bonds, make some profit, and you decide to sell, you pay tax. But you always tell your client, when you buy a home, you make some profit and you decide to sell. For most home sellers, that would not pay any tax. We have that special capital gains exemption. And what Congress wanted to do, both chambers actually passed. House of Representatives passed, Senate agreed, and they passed. And they said, in order to get this capital gains exemption from real estate sale, you have to live in your home for 5 years. Because we remember, wasn't it 2 years? 2 out of 5 years, well, very specifically. And we said, if you put it at 5 years, many families who need to move will be hurt by this, pay unnecessary tax burden, rise in taxes, tax burden through it, especially the military families who are forced to move frequently. So they backed away, and so the capital gains exemption was retained as before. And I also want to thank you, because I know that many of people in this audience responded to call to action. In fact, nationwide, we had 300,000 realtor members push the button to say that these real estate issues are very important, and that letter under your signature went to your elected representative to say, I consider this to be very important. And I think that really led to this compromise measure where we have this tax preference broadly in place. The 1031 exchange, we thought that would be most vulnerable item for chopping. Because every time we speak with congressional staff about 1031 exchange, very important for second home purchasers who can use some of it for 1031 exchange, or real estate investors, very, very critical for commercial real estate practitioners. We were very concerned because every time we spoke with congressional staff, they always would say, what the heck is 1031 exchange? So if they don't know it, it's easily to be on the chopping block, but fortunately they understood how important it is for local economic development, economic growth, so that was protected. Other thing that was added at the last minute was, this is not related to home buying or home selling, but you as a small business owner, because part of the tax reform was corporate tax cut. What about for the small guys? Why come the small guys as a business owner would get some tax cut? So as part of that, what was included is additional business deduction. The final language they're still working on, but essentially it would look something like the following. Say your net commission income is $50,000. So you have gross commission income minus all the deduction, car expense, the advertisement expense, so your net is $50,000. And you face tax rate from that. Well, under the new law, next time you file your tax in 2018, you get to deduct 20% of that net income, meaning that 50,000, 20% is 10,000, so 50,000 minus 10,000, and so that would be net of 40,000, and you will pay tax on 40,000 rather than on 50,000 as a business owner. So that was put into place to say that, well, if corporations are going to get tax cut, then small business owners will get tax cut. I will also add, we are still working on some of the income phase out. That is to say, if you happen to be very successful business owner making $500,000 or $1 million, you don't get that deduction that I mentioned. Because we are saying, well, corporations are getting it, but if the one happens to be very successful, that should also be considered that 20% deduction. We are still working on that, but right now it's an income phase out, so that for most realtors, they will be able to get 20% deduction, but if you're on the very, very high income as a small business owner, you may not get that 20% deduction, but we are still working on that. In Florida, it looks like the following under the new tax reform. 98% of homeowners in Florida pay less than $10,000 in property tax annually. 95% of homeowners have less than $750,000 in mortgage. You know that Naples is a special place, very expensive place, but other parts of Florida, home values, don't even come close to $300,000. So, most would not have mortgaged that amount. But even a $4 million waterfront home here in Naples is probably already paid off, so they don't have a mortgage or very small mortgage. So when you look at only the mortgage amount, it's 95% of homeowners. So what does this mean? You can tell your client, even though they have limited mortgage interest deduction or property tax deduction, most Floridians would be fully able to deduct if they wanted to. Now, one big change is they have raised the standard deduction, so many people will choose the standard deduction rather than itemized deduction of mortgage interest and others. So that will change, but if their financial circumstances change and they have to itemize, be comfortable knowing that most Floridians would be fully able to deduct if they wanted to. So this is very comforting. But there are some areas where people would not be able to fully deduct, and some states would be impacted, principally people living in Connecticut, people living in New York, New Jersey, California, Illinois, because their state taxes are very high, so even $10,000 does not fully cover that, which means this could be actually a good news for Florida, because we have seen the migration trend from northern states into Florida, and with this tax reform changes, that trend could accelerate, meaning that as people are near retirement, they say, why am I living in Illinois when my tax burden would greatly lighten if I was to move to Florida? So we may begin to see some of that trend going into the future. In the meantime, housing market has been recovering. Cindy was mentioning about various micro level areas in Naples, but nationwide and also Naples is somewhat unique because again, expensive property. People are not really. There are many people who are not working, but they are bringing their retirement wealth here. So it's a different type of market. But overall, the trend has been that 2005 it was peak for the country. It was peak in Naples, and then it crashed. And there was a lot of foreclosure resulting from it. But then there's a steady recovery. And note that the recovery has been much more moderate recovery rather than a fast-paced recovery. And that's a good news because it's implying a healthy recovery rather than a frenzied recovery or return of the subprime lending. We don't have a return of the subprime lending, so fortunately, the recovery tends to be a more moderate pace, more sustainable long-term growth. And recent quarter, go to neighbor website. You can get even much more detailed information, condominium breakout, single-family breakout, this price point breakout. But this is the top line number. Top line number is saying that unit sales are up 5%. Prices are up 12%, average prices, which means that dollar commission revenue income will be up about 17% if you are matching up with the overall market trend. Individual agent, sometimes they do well, sometimes they are challenged, but for large brokerages, they should be roughly following this statistical number. The inventories are down, like most parts of the country. 95 days on the market, I would say that this is about right, because in some markets, like in Seattle, the days on the markets are 15. So a home comes on the market, and just anecdotal story as we were talking over the lunch, that homes are being sold 50% above listed price because of the multiple bidding process and significant shortage of inventory in that market. But here, people do not need to make a rush decision. Their homes on the market, and also because of the very upper-end market always takes much, much longer to find that right buyer because those are unique properties. The pending contracts also is implying that this is a month-to-month figure, not an annual figure. So you see a little volatility, but for the past 2-3 years, it's not breaking out one way or the other. If we look at the 12-month period, it is showing slight growth compared to the year before over a 12-month period, but month-to-month, it's not really breaking out. One thing to note is that red arrow, which went down. And I think Cindy had mentioned that there was market softness back in 2014 period. Well, the nation also saw some slowdown in market condition. And economic backdrop at that time was economy was creating jobs. So job market was doing fine. Stock market was still on the part of the bull run. I mean, today is much higher than then, but it was still rising at that time, consumer confidence. So why would it decline at that time? Well, it declined because mortgage rate had suddenly spiked up from 3.5% to 4.5% overnight. If you remember that time period where you said you are working with a client, 3.5%, the next day is 4.5%. Sudden shock to the market system, that began to pull back some buyers. And then once the interest rates steadily go back down again, then the buyers start returning again. Now, I mentioned that because today's mortgage rate is much higher compared to 1 year before. Yet, even at higher mortgage rates, we're running essentially even compared to 1 year before. Naples is actually doing better than last year, even at higher interest rate. So back in 2013, 2014, softness in the market because of rising interest rate. This time, rising interest rate not really having a negative impact, but it's not a positive impact, certainly. So it's moving more sideways. And in the Naples market, compared to 1 year before, which properties are seeing the biggest unit sales growth? Higher the price range, bigger percentage gains. On the lower end, let's say 300,000 and below, I think that's what it looks like. Unit sales are lower compared to 1 year before. But I would say if I was to ask you a question, Why is it lower? You would say because of lack of inventory. If you had more homes on that 300,000 or 200,000 level, you would make them more transactions. But it's the lack of inventory that is making it go down. So we need more inventory on the lower affordable home range. The consumer confidence is very important for home purchase because it's not only purchase of a home is such a major expenditure, not a purchase of a chewing gum or purchase of a tomato. It is probably the biggest expenditure that people make. They need to feel confident about the economy. They need to feel confident about their wealth. They need to feel confident about their job situation. So confidence is important, and note that confidence levels is at near historic highs. So it is a very, very high levels. The midterm election is coming in this November. Some people are saying it will be a huge sweep by the Democrats because of a lot of stuff, tweeting coming out of White House. But at the same time, other people are saying, look, it's going to be actually quite a surprise where Republicans hold on to many seats, because if you look at the consumer confidence level, even though people may be frustrated about this or that, if they strictly focus on the economy, about the economic issues, at least on average Americans are saying, I feel good about the economy. So at least the economic confidence level remains very high. But the home buying confidence, recently we saw a measurable decline. This is a survey by us to randomly select the consumers across the country, asking some simple questions, including, is it a good time to buy a home? And how many people are saying it? So you see those red dots, and the most recent quarter, first quarter, it declined. So we were concerned, are people concerned about the rising mortgage rates? Is that the reason? Why are people less optimistic about buying a home? And when we delve into the question a little deeper, what we are finding is consumers are not excited about the inventory choices. Lack of inventory, especially on the mid-price or lower price points. And in some markets where they feel hurried in their decision, like in Seattle, Denver, where they have to make hurried decisions. If you they flip through the cable channels, the HGTV or one of those channels, they show you 3 homes, A, B, or C. Which one is right for you? Well, you don't have chance to even contemplate A, B, or C. They're going to show you only A, and you either you have to pay above appraisal price or listed price, or you're not going to get that home in many markets across the country. And I would say that was probably the case in Orlando market, in other parts of the Florida market as well. Again, Naples is more unique because this is a very upper-end market part. So what the consumers are expressing displeasure, in other words, is lack of inventory. If there is more inventory, they would feel more confident and optimistic about going into the market. Market has recovered. This is the price index. So it's not a median price. It's just trying to measure price appreciation. So if you start from 1995, home prices in Naples, which is in yellow, has tripled from 1995, even through that cycle. You look at the big boom, bust, and it is not back up to the prior peak level, but it's climbing very, very fast. Tampa is very similar, Sarasota, very similar trend, but Naples, you see a bigger swing part. I put Dayton because I happened to be in Ohio, I think a couple of weeks ago, and found that very contrasting, that to say that all real estate has their local flavors to it. In Dayton, prices over this 20-year time span has only risen by 40%, not tripling as it has occurred here in Naples. National average. So there's markets like Dayton, there's markets like Naples, and you average all up, home prices over the past 5 years or 6 years has risen by 48%. But people's income has only risen by 15%. And you have to, let me pose this question to you. Would this be the case next 5 years? And you would have to say, well, if it happened in the past 5 years, surely it cannot happen in the next 5 years because something does not appear right when home prices greatly outpace income. So either home price growth has to drastically slow down to catch up with income growth, or income has to really be boosted. And I don't think anyone is forecasting people's income will be rising at 10% a year. So somehow home prices have to moderate over the next 5 years. How do you moderate prices over the next 5 years? There's two ways, one bad way and one good way. Bad way would be to chalk off demand. You chalk off demand to say don't buy a home, either by raising guarantee fee by Fannie and Freddie, making the mortgages even more expensive, making it flood insurance very costly. So you make home buying much more expensive to choke off demand. So you choke off demand, and then prices moderate because people are not buying. But that is not the way we want to do, because it hurts your income, it hurts the housing market, it hurts the home sellers, and also it hurts the local economy. So we don't want that. So how do we get moderation in prices? Build more homes where there is a strong demand, and that is in the moderate price range. So if you build more homes in the moderate price range, then we can moderate prices and also have increased home sales. So increased transaction activity for you. So we need to think about building more homes. But if the builders are not building moderately priced home, why are they not building? What kind of obstacle are they facing? Is it high impact fees? Is it the local zoning laws, stringent zoning laws? Or it could be that the banks are unwilling to lend because they've been constrained by Dodd-Frank regulation. Maybe Dodd-Frank regulation, financial regulation is a very good thing for Wall Street companies, but maybe community banks, they need to be freed up so they can make those loans for the home builders. So we need to look at all the areas where we can increase home building, especially on the moderate price points, and that will help moderate prices. You have more transaction, there's more job creation, so many, many positive scenarios. And the renters are currently expressing frustration because their income growth is not catching up with the prices. How many are indicating that they are facing difficulty in saving up for down payment? The light blue is for renters becoming first-time buyers, while the purple line is homeowners buying their next home. So homeowners are saying no problem because they can sell their home, use their equity as a down payment for their next home purchase. But it's the renters who are expressing difficulty. And by the way, these are successful renter to homeowner conversion. But just think about how many renters are unsuccessful in becoming homeowners. So because of the disparity in home price growth and income growth is making it more and more challenging to save up for a down payment. And that is another reason why home ownership rate is stuck at historically low levels. It is trying to make slow comeback, but essentially near 50-year lows in home ownership rate. But home ownership rate being low is not people's aspiration, it's what it is. But if we ask their aspiration question, do you consider owning a home as part of your American dream? You know, however one wants to define American dream. And 80% said yes, it is part of my American dream, and 85% would like to own a property at some time in the future. So low home ownership rate that you saw in the prior chart, this one, is not what Americans want. Americans want higher home ownership, but we want to make sure we don't have a return to subprime lending. We want a good, successful home ownership, but that also means we need to build more homes, especially on the moderately priced home, so that we can provide more opportunity for renter to successful home ownership conversion. It is important also for the society, because when we look at the wealth distribution between homeowners and renters, it is colossal. So a typical renter, what do you have on net? You sell everything. You sell your automobile, you sell how much money you have in the bank, so you add up everything minus their liability, and typical renters would have about $5,000. Some renters 0, other renters 10, but on average 5,000. For homeowners, you can see it is substantially higher. And I purposely chose 2 time period, year 2000, which is a blue period, blue line, and red is the most recently available data from the Federal Reserve, 2016, which is about $230,000, substantially higher. And most of that wealth is tied to their homes. So if we have a low home ownership rate, and this is the wealth difference between renters and homeowners, then society's wealth inequality will be intensifying. So we need to assure that home ownership opportunity, again, successful home ownership, not a return to subprime, is available so that more people can participate in the wealth buildup in the country. Here's my prediction regarding Britain. Next British government is probably likely to be a die-hard socialist. Why? Income inequality between renters and homeowners in Britain is even worse than this, and home ownership rate has plunged. So people who are renters in Britain are saying, heck, I want to try anything. I'm willing to try out a radical policy because I'm not gaining anything while just very few people are gaining. Today, America, we can say that fortunately 60+% are homeowners, meaning a comfortable majority, but historically it's been the higher level. And it's certainly as people become property owners, naturally homeowners want to defend property rights. So you have that natural inclination in defending of the property rights. So we need to, again, facilitate more home building so more people can have access to homes. Homeowners are much healthier also. The red is Florida, blue is US. This is the default rate of people in foreclosure. You can see a rapid improvement as home prices are rising, job creation. The only recent uptick in the red line in Florida is related to hurricanes. So hurricane impacted especially small business owners where they don't have a steady 2-week salary income, and some people just cannot make the mortgage payments. So it increased. But now that hurricane is out of the way, things are improving. I think that the default rate will be declining on the next data point that we see. Let me actually just skip this just for the sake of time. The inventory level overall for the country has been declining in this fashion. Naples inventory decline has been more moderate pace, so you do have enough sufficient inventory, but you have many very expensive homes, in which just generally it takes longer to sell. Homeowners have been staying in their home for much longer to sell their home than in the past. In the past, typical homeowners stayed in their home for about 7 years and then say, well, this home does not fit our lifestyle. Or now they become empty nesters. Or they have a school-age kid going from elementary school to middle school, so they want to change school district. So there was always some movement in people among homeowners, and they typically live in their home for about 7 years. But now they're living in there for 10 years, which means that there could be some itching among homeowners to say, maybe this home really doesn't fit my lifestyle today. So I think there could be some pent-up sellers who want to reach the market, but they need more inventory choices before they list their home. And here's the single-family permits in the Naples region. So you see that before the housing market crash, what it was, and then you see the crash occurring, and then it's slowly coming back, but it's almost been 10 years where home building, single-family building in Naples region is well below what it had been in the year 2000. So slow rate of building activity in Naples. And in multifamily, which includes condominiums, you can see the recovery has been even slower compared to the single-family. Mortgage rates, now higher compared to 1 year before. Some of your clients may be saying, well, last time there was a spike in mortgage rate, if you waited, it declined. Then when there was a second spike, it declined again. So some people may be saying, well, maybe I should just wait, and the mortgage rate will decline. Sorry. We are in a permanently higher interest rate environment. Longer you wait, more likely to be higher interest rate. 4.5% today, this time next year, probably over 5%. It will be a steady increase in mortgage rate because there are so many factors pointing towards higher interest rates. What are some of those factors? Federal Reserve is raising interest rates. Sometimes what they raise do not impact mortgage rate one-to-one. But if they continue to increase, it's going to nudge up mortgage rates. Federal Reserve probably will raise rates 2 times this year, 3 times next year. So it is in a rising interest rate environment. Another reason why the interest rate would rise, this is the balance sheet of the Federal Reserve. And what the heck is this? Well, several years ago, Federal Reserve pursued an aggressive monetary policy of quantitative easing. in everyday language, printing a lot of money. They print a lot of money, and you say, what the heck happened to those money? You did not reach my pocket. Well, they printed the money to buy government bonds and mortgage-backed securities. It did reach consumers through lower interest rates. That's why the consumers face lower interest rates. Now they want to unwind this, meaning they have to sell this balance sheet. Only way to sell it is to offer higher interest rates. So that will be another factor why interest rate will be higher coming up. And inflation is beginning to pick up. Gas prices are rising, and we have a tight labor market. So generally, inflation rises. From lenders' point of view, they give you the money, but when they get the money back, they want to be assured they are not losing purchasing power. But if there's an inflation, they are losing purchasing power. Therefore, only way to compensate for that higher inflation from lenders' point of view is to say, I have to charge you a higher interest rate. So another factor as to why interest rate will be rising. So if your customers say, maybe I should wait 6 months and then interest rate will be lower. Again, it will not be happening. If they wait and wait and wait, more likely it will be a higher interest rate than before. Let me say, tight labor market, unemployment rate of 4%. Let me just quickly go to the job market because that will be something very important. So this is a nationwide job market condition. And here's Naples metro market. So you see the boom, bust, and now the recovery. So even though wealthy retirees move into the area, they're moving in as a retiree, meaning they're not looking for jobs. So they're not counted in these statistics. However, you need people working in the hospital, you need people working in the restaurant, you need the home builders. So all this job is still related, people who are working, and you can see the job growth has been quite solid in terms of recovery. There's some seasonal patterns here. I don't know in Naples whether there's more job in the winter versus summer or vice versa, but anyway, there's a little seasonal patterns. But over the long term, look at this long-term situation. From year 2000 to today, Naples area job growth grew by 53%, while nation only grew by 13%. That's almost 5-to-1 ratio, almost 5-to-1 ratio, which is implying that continuing situation where this area is doing much better than rest of the country. And if this pattern holds, you are looking at possibly a local area 15 years from now with about 300,000 jobs. I'm not sure if this is what you want, but if this pattern was to continue, this is what you are looking at. So if that many people, what it would do to the housing prices. So do you want to hold real estate knowing that this would be the trend, or do you want to sell your real estate? So anyway, that's very strong phenomena related to the job market. The Dayton market, where you saw the low prices, well, this is what's happening on their job market, and you see why the price growth is not just occurring. So total job opening for the country right now is at sky-high levels. Insurance filing for unemployment check is at historically low, meaning no economic recession over the horizon. Very, very good picture, no economic recession. Construction workers are rising, but I would say if there's one big constraint for home builders, I mentioned about the impact PE zoning, possibly the lending constraint on the community-sized bank. Other is lack of construction workers. We have forced every high school students to go to college, and is that the right way to go? Or should some people who are not really interested in academic, who are not interested in textbooks, maybe they are interested in just working in the real world, trade skills, wood framers, welders, electricians, plumbers. There's a shortage. If you were needed to get a home repair, just see how difficult it is to find a repair person now because we are running into shortage. And the builders are saying even if they can get the loan, they cannot find the skilled workers. And hence, sometimes they go into the undocumented workers, illegal immigrants. If we want to increase trade workers among American domestic workers, we need to assure that community colleges or there's some trade school to crank out people who are not college bound, and this will help facilitate more home construction. More home construction means more business opportunity for you. So this is one of the constraints. Let me just skip that for the sake of time and go into the forecast. So the forecast is that no economic recession, probably a 2%, 2.6% GDP growth, which means that it will be about a little shy of what President Trump would like to see. He'd like to see 3%. If we were to get 3%, we should cheer that. But I don't think, given all the momentum and other part, that we can get to 3%, but it's close to 3%. Job growth will continue. You know that Naples does better than the rest of the country in terms of percentage growth. Inflation will slightly pick up. And as to the housing forecast, you are looking at newly constructed home sales doing well. Whatever builders build, they are able to sell, especially moderate price homes. The existing homes, I would say, is going to run even because this is what we are seeing so far in the data, maybe squeaking out 1 or 2%, but no meaningful change compared to last year. If you believe last year your business was good, it's going to match that level. That's what it's saying. So the existing home sale will be roughly the same. The prices will be rising, so that's where most of your commission income growth will be coming from, the price growth, and the mortgage rate will be trending higher, and by 2019, mortgage rate will be even higher than this. Commercial, sorry, I did not go into the commercial for the sake of time, but I think overall the market is optimistic over the next year. But if you are patient, and just in terms of the real estate investor holding on to real estate, you go into 15 years and look back, I think the Naples prices will be just so sky high that it would have been one of the best investments that you would have made. So thank you very much.